All right.
Okay, welcome everybody. Thank you for joining us today. We are broadcasting live from suburban Philadelphia and Tampa, Florida. If somebody wouldn't mind just sending us a note in the chat box to let us know that we're getting out there and you can hear us, just say hello is totally fine. Thank you for spending your afternoon with us. Paula, look who's on there. The thing that I would like, Michael, thank you. What I'd like to do is encourage you, and we welcome, and please feel free to ask any question that you like. The format is super simple. We're just going to be chatting about what's going on with Eric and context and what's going on in the world as it relates to some subject matter that you saw in the invitation. But we're open to anything. So we have a lot of people joining us today. We can't see or hear you, but you are so welcome to do the Q&A or the chat box, and we'll get to as many questions as you can as we go along here. So feel free to put them in as you think of them, and we'll attack as many as we can get. Super happy and big thank you to Nicholas, who I've known just for a short period of time, but it's been my pleasure to know Nicholas, and he's involved with Context as well. And he's the one that arranged this. And so we can hear from Eric and what's going on in the world, but also what's going on with Context. And so just for the record, a little Zoom housekeeping. We're recording this. We're going to post it on the Family Office Insights YouTube channel. And you can look at it later or share it with anybody that you think might benefit from hearing what we chatted about today. And again, I'd like to thank you for spending your afternoon here on a Thursday with us. And with that, I'm going to introduce Eric, and off we go. Please, again, feel free to ask away. Welcome, Eric. It's all yours.
Very proud to be part of the Family Office Insights series. Thank you for having me.
You're very welcome.
So as you might know, you talked earlier about you're from Tampa or in Tampa, and I'm in suburban Philadelphia. But as it turns out, we discovered just by early chatting that we lived next to one another, or virtually next to one another, for 20 years. Didn't even know it.
You didn't even know it. Yeah. What Eric is talking about, I lived in Villanova outside of Philadelphia, and that's essentially where Nick is and has lived there in a while. So it was a great place to live and super enjoyed it, as did my children and yours, I guess. Yeah,
absolutely.
So why don't you tell us a little bit about you, a little bit of background, and what you told me just prior to our call about how you evolved into this role, I think is interesting as well.
Yeah, so I actually grew up in the exchange and trading space. So I started my career, what now seems to be many decades ago, at the CBOE in Chicago, where I designed new products for the options floor and did strategic planning. And that eventually evolved to a 16-year stint with Susquehanna International Group, the very large options market making and equity trading firm. And now they make markets in everything. And then after that, I was recruited to run the exchanges for NASDAQ, which I did for 5 years. I ran all the equity option and futures exchanges for NASDAQ for that period of time. And then I ran a large agency broker-dealer in New York called Convergex, which was a competitor to Instinet and to ITG, if you know those.
I remember it, yeah.
Yeah, and it was private equity backed, and we ended up selling it. And then I joined some old colleagues of mine in Context Capital Partners. And Context Capital Partners is an investment vehicle which owns and operates several different kind of operating companies in the financial services space, one of which happens to be Context Summits, which is one of the reasons why we know one another, which is essentially a capital introduction platform and events business that has been around for about 12 years. And then recently we went through some management changes. So I've taken on the CE role of the Summits business as well.
Yeah, we were talking earlier, I think to a person, during its history, and now the conferences were always something that the hedge funds look forward to going to because of the matching of the institutional and other investors, and people could pretty much align with what they were interested in, and have an in-person meeting and then take it from there. So it was always thought of fondly to me, and I have no skin in the game here, audience. It's just that was the sentiment, it seemed.
Yeah,
So
yeah. I think what's interesting from my perspective and what attracted us to this model and why we continue to believe in it and invest in it is, it's really a conflict-free, because we have no skin in the game here in the sense of in that capital introduction process for us, whether it's successful for a fund to raise money on our platform, whether it's successful for an allocator to allocate funds on our platform. We of course want everyone to have a great experience, but we don't have a benefit for that. We don't have an override for that. We don't get paid for the connection. We charge a subscription fee, or when we do an in-person event, we charge an event fee. And really, what we bring to the table here in this business is a very large pool of funds, and they're mostly hedge funds, but they could also be private equity or VC or special purpose vehicles or real estate funds and allocators. And we use a very complex algorithmic system to essentially matchmake between those parties and make that introduction. Now, really the way we do it is the funds are the only side that pay, and they pay a subscription fee. Allocators participate for free. And it's really, we let the allocator do most of the driving here. So we provide to the allocator who's on the platform and who's interested in participating, their ability to define what they want out of their interactions on the platform, and then drive their own engagement. So if they can find funds that they would like to meet with, we actually have virtual meeting rooms on our 365 platform you can drop into and have your virtual meeting right there.
So I've had an opportunity to see it in action, and I hadn't seen it before, however it existed prior. How long has it been this robust and algo driven, and the interface is good, very good? How long has it been that robust?
Really since October. So it's very new. The various pieces of this existed before, but they were in the service of the in-person events business.
Right.
With the advent of the pandemic, what we did is we took that offline, and we essentially recoalesced and reimagined what a true digital platform should look like. Built that through the bulk of the pandemic and relaunched it in October.
So the natural question that one would ask to warrant a subscription is, and it's probably too early to tell, do you have a sense of any metrics in terms of allocations, or just connectivity?
Yeah, so we don't track what we don't track. So we don't, again, because we don't view it as our
Get paid. Well, you don't get paid that way. Yeah.
We don't get paid that way. So we don't track whether an allocation takes place or not. What we've been told through surveys we conduct with our clients is about $46 billion has been allocated coming out of meetings that were held through context in the last 2 years. So that's in person, and that's also digitally on the platform. What we do know is we have about 1,300 funds that are on the platform today with their information and their data, their marketing decks, their tear sheets, their return data. And then on the allocator side, there's roughly about 1,100 allocators who have logins, and they're coming in and interacting with one another on a regular basis. One of the really interesting things we've learned, though, when we were only an events business, what would happen at an event is everybody would have a really high number of meetings in a very short period of time. So for example, our last in-person event, which was January of 2020, we had a little less than 11,000 one-on-one meetings in 2 days.
Wow.
So everybody was super focused on those 2 days to having those meetings. what we've learned now is that the allocators coming into this are spending a lot of time doing research on our platform before they go to the meeting. So the number of meetings that take place aren't concentrated in a couple of days. They're coming in 2s and 3s a week. So participants, and I don't mean in total, I mean for an
Right.
individual
Yeah.
allocator. So they're doing a lot of research, and then they ask to meet with a hedge fund. And so it's a much more part of their work process now, which is, quite frankly, was a little bit more of a surprise to us.
That's interesting. But one would argue that given access to data, that you can not waste the hedge fund's time and not waste your time, and you can sort of narrow the fire hose, so to speak, and just talk to people that are more likely to be something you want to allocate funds to, as opposed to just hoping that you can.
Yeah. Yeah, and we tried to build into the search patterns for this. We've tried to build in the necessary tools. So you can track this from I want a Sorrentino number of X, or I want a Sharpe ratio above or below a certain amount, AUM, style, all of those kinds of things. But we also have put some other things in there to help people really sort of narrow what they're interested in. So what are the hot funds? What are all the other allocators looking at? So what are the ones that are getting the most attention? Are they ESG? Are they minority owned? Are they women managed? In case you have those kind of mandates or those kind of interests as an investor. And so we've tried to make this a very robust algorithmic search, so that when you as an allocator are on the platform, you're only really seeing those funds that meet the needs that you've identified.
What you said there is interesting, and I was smiling because one of the biggest questions I get that I don't have an answer to in any meaningful way is, what are family offices doing? Which is such a wide open question. And I would argue a great question, but I don't have an answer. In the context of what you just said, do the allocators have a sense of what other allocators are interested in?
So they don't, not yet.
Yeah.
So one of the things that we'll be bringing out towards the end of this month is an ability for allocators to only speak with other allocators. Is to create that sort of, because one of the things that, quite frankly, that we miss a lot, and our funds miss a lot, and our allocators miss a lot from in-person events, is the informal get together in the hallway. Yeah. Where you're looking at one another and saying, well, I really like those guys, or I really didn't like those guys, and what do you think? And that has disappeared in the new digital world, unless you have a one-on-one friend relationship with someone.
An incumbent relationship that you already can call on, right?
Exactly. So we're going to try to create that community through an allocator to allocator portal and interaction that allows allocators to essentially talk to one another. I'm looking for something. I'm looking for a life settlement fund. How many of you are invested in them, and which ones do you like? And can anyone give me any advice around that, just as examples? And to try to stimulate that kind of, or replicate that kind of in-person thing that has gone on in meetings. As someone who sees the platform and sees where the meetings are coming, there's some really interesting sort of insights that we're starting to see come out of that. Now, we don't monetize that. And again, we don't view that as our business to monetize that. But I think it's really interesting. One of the things that we've really seen is a giant growth in interest in non-correlated funds, non-correlated to the S&P 500. So since the end of the year, December-ish, growing into this year, a great deal of interest in trying to find funds, royalty funds, other kinds of cash flow funds, private credit, things that don't have a high correlation to the equity markets. And those seem to have really picked up in interest. Crypto has also, shown a great deal of interest, people wanting to institutionalize crypto investments and take a bigger look at those. So those have been really, that's been an interesting trend to see happen through the platform.
So in the context of trending, and of course, in my little world, they're not institutional investors, except to the extent that the family offices are institutions. So when I'm asked the trending question, it's only related to that, which I said I couldn't answer. But in your view, are the allocators that you see, is it fair to ask you to make a statement about what percentage of them are family offices as opposed to
Yeah, so
wealth funds or that sort of thing?
yeah, absolutely. I would say the percentages break down kind of like this on our platform, which is a good 70% of our allocators are single family offices or multifamily offices. So we are very focused and very heavily concentrated in that family office space. The other 30% are either foundations, endowments, pension funds, the sort of more classically larger, we have some sovereign wealth funds, the more classically larger institutional investors. And this probably won't surprise you being in this business, is the single family offices more than any other seem to be the ones out in front of looking at newer stuff.
That is, yeah. Well, and this is not to be disparaging, it's just to call it what it is. Multifamily offices are wealth management platforms that have lots of family offices as their clients. So they tend not to be out front because they're stewards of capital as opposed to the ones making a decision about taking a bet or something new. Or
Yeah, and by no means am I trying to imply that they're taking risky bets or anything like that. I just think that they're more open and innovative about where they're wanting to put their money to work. And so we've seen them really be at the sort of the leading edge of investment cycles on the platform.
So aside from non-correlated, which one would argue makes sense because of where the S&P is, maybe it's a little frothy, maybe it's not, but one would want to prepare for, in the case that it is, to have non-correlated investments, crypto, and what was the third thing you said?
Well, I had mentioned royalty funds or other cash flow,
Non-correlated,
monetization of different kinds of cash flows. We've seen a fair amount of that. We've also seen, we have a couple of SPAC and hedge fund managers, not investors in, they're not individual SPACs, but they are hedge funds who invest in the SPAC space.
Yeah.
And that's been a big area as well. It's obviously all over the news all the time as well.
Yeah. So aside from the insights to the trends that you've seen and what you've shared to us, would you care to share your views on some of this stuff for the audience?
I'd be happy to. And I don't know how much, part of my background, which I gave you in the beginning, is around market structure and trading as well. So if people are interested in hearing, sort of what I'll call the meme stock or game stock phenomena discussions as well.
Let's talk about that. Yeah.
I'm happy to talk about that as well. One of the impacts, I think, for investors and allocators in single family offices and hedge fund managers coming out of the whole GameStop phenomena is, one, there's a giant surge of liquidity and trading interest, not just in the meme stocks, but in penny stocks in general.
Really?
But what has generally been a very sort of unlooked at, uncared for,
Off the radar, yeah.
off the radar space has become very, very, a lot of people are starting to put their eyes on it. And there's been some really crazy anomalous results that we've seen. People who have been involved in accumulating very large positions in some of these small penny stock companies have all of a sudden seen them go from 10 cents a share to $10 a share. And
so those of us who are cynical might suggest that that is not exactly what the regulators hope to see.
And that's 100% true. In another part of my life, I'm a governor of FINRA. So I just want to make it clear that
Full
as I
disclosure, yeah.
full disclosure, I sit on the board of FINRA as a governor, and my comments around these things are my comments, not FINRA's.
Fair
So I
enough.
don't want to
Okay.
misinterpret them. But yes, and this is an area I think is going to get a lot of focus, particularly under the new political administration as well, which is, have the markets been gamified? And that's looking at the way Robinhood and some of these other platforms encourage people to trade more.
Yeah.
Showers of confetti when you buy a stock, trumpets blaring when all the things that that our children have grown up with on their phones in terms of the games they play on their phones are now part and parcel of many of these investment platforms. And so I think there's going to be a lot of regulatory focus on that. But there's also going to be a ton of focus on how do you protect investors at the same time as allowing personal freedom and people to invest and take the kind of risks that they want to take. And the traditional answers to those questions from the regulatory point of view have been investor education and transparency.
Disclosure, right? Yeah.
Disclosure, right? Just saying this is what's going to happen, or this is what could happen. It's going to be a fascinating exercise though coming up, because I suspect that people are going to be arguing for some different answers now to some of those. I actually heard of one congressman who will remain nameless actually suggesting introducing legislation to take away all of the gee whiz features on some of these investment platforms and broker dealers to make them boring, to take away the gamification aspects of them by law. And that's really intriguing when you think about it, because obviously there are tons of video games that are out there that entice people to play. There are gambling websites that entice people to gamble. But you could make the case that investing in U.S. equities is at least has a potentially positive return, since equities typically have an upward slope to them. So you could argue that there's a positive expectancy to investing, whereas if I'm on a gambling website, I have a negative expectancy because I'm a dead loser.
Odds, yeah.
But it's interesting that we were going to try to keep people from going into the one side while we don't restrict it on the other. It's a fascinating debate, and I'm not sure how it's going to end up yet.
Yeah, super. It would be interesting to watch anyway. This is just my opinion. I think that platforms, and we use Robinhood just because of its notoriety, but there's many, they are gamified. I mean, let's call it what it is. I mean, I'm just saying that. I'm not asking you to say that, but they are. And whether it's a good thing or a bad thing and how that will play out will be super fun to watch. What about Reddit?
So that's going to be another area. So, traditionally, investors are allowed to talk their own book, right? I was watching CNBC this morning while I was getting dressed, and Ron Barron was on talking about
saw that.
He
sold a bunch of Tesla.
Basically told us that we should own Tesla for the rest of our lives, right? He happens to have a big stake in Tesla, and that was all disclosed. There's nothing wrong with that. How different is what he did this morning, though, from Reddit? So guys,
argue not different at all, right?
Or not different at all. And so there's some people were saying, well, they're conspiring with one another to drive stock prices up. Yeah, that's a difficult case to prove. What they're saying is, I own this name, and I think everyone should own this name, and no one should sell. And I think it's going to 1,000. How different is that from Leon Cooperman or Ron Barron or anyone else talking about a stock they happen to love that's in their portfolio? I'm not sure there's much of a distinction there. So trying to find where the conspiracy is around that, or the coordination around that, which could be illegal, seems to be maybe difficult to find.
Yeah, and I think the whole regulatory, and I'm sorry, this is your your meeting, but
I don't know. This is, I'm
uh,
happy to talk about this stuff.
but I think the regulatory construct is, and by rights, I think, designed to protect the investor from nefarious investment advisors, et cetera, and from themselves, right? So just by definition, that's a very hard balance to strike, and do it without being called out. You know, since you're a governor, I'm not going to say all regulators are unliked, but they come with their, their baggage, right? So,
And they
but
bring inherent biases to it, right?
yeah,
Just by the nature of what they do.
yeah. So, how about yeah, we're hitting all on the news items. How about the Bitcoin positions that have been compiled and all that business?
Yeah, I think one of the more interesting things that we've seen, and we've done a couple of webinars and a couple of information sessions on cryptocurrencies and the institutionalization of crypto, or at least how you could potentially participate as an investor, as opposed to just buying some Bitcoin, which have been interesting. But one of the things I think that's really started to pop up now is the idea that cryptocurrencies in general are starting to receive acceptance as a real store of value, not as a currency, but as a store of value. So essentially like gold, as opposed to a dollar bill. And they still remain highly, highly volatile. They move around a lot. I don't know where Bitcoin is right now, but it's down from its high.
It's 46, 49, something like that. Yeah.
But it moves around a lot, very highly volatile. But one of the things we've seen on the platform is, on the Context 365 platform, is one, a whole lot of new funds coming in who want to manage exposure to cryptocurrencies in some way or another. And they all have different kinds of strategies around them. But just an increasing amount of people who are showing an interest in wanting to or have meetings with them. I don't know if they ultimately allocate to them or not, but we've seen that trend start to pick up. Some of that is headline driven, obviously.
Yeah.
When Bitcoin hits new highs, people are like, why am I not in it? I got to figure out how to get exposure. So some of it's headline driven, but I do think we're starting to see that sort of normalcy of it as a space, where people are thinking of it now as an asset class, as something where I can put money to work in.
Where many who were knee deep in it had already been convinced of that. When you have notable people that everybody knows voting with their checkbook,
Yep.
and good or bad, right or wrong, it gives optics that cause it to seem credible, whether it is or not. And I'm not saying that it is or it isn't. We
Yeah,
have a
when you have Elon Musk and then MicroStrategy and
yeah,
Novograd,
yeah,
all putting money to work in this space, it drives attention.
no doubt. Would you mind if we took a question from the audience?
Feel free. Thank you.
So from our friend Jerry, in terms of the amount of allocators, not the dollar value, are you seeing an increase or a decrease over the last 1 to 3 years in seeing more or less alternative strategy managers?
So I'll answer this, Jerry, in two different ways. One is, we've seen a growth in family offices. So there's no question that what we've seen historically over the last 10 to 15 years in our economy is the creation of some additional pockets of real wealth in people. And they tend to be, if I could use this phrase, much more self-actualized as investors than past history has indicated that people who have accumulated wealth are. So they want to manage their own money, or they want to have a more direct impact in their day-to-day management of their wealth than previous generations have, who typically gave their money to the trust fund officer or somebody else. So we've seen a big growth in the family office space, in the number of family offices, and they are much more active. So I would say that the number of allocators has grown. Because until most recently, within the last year, there was almost no volatility in the marketplace. So leave aside 2020 for a minute and 2021, where that sort of changed the dynamic a little bit. But prior to that, markets were on a straight upward trajectory. There was almost no volatility in the marketplace. And we saw a lot of alternative strategies fall out of favor because of that. Because the ability to fundamentally beat the market, the ability to do a true long short and generate alpha, all seem to be difficult to do in a low vol, upward moving market with higher fees. And so, what we saw is the number of hedge funds came down fairly rapidly. And the number of alternative investment vehicles came down fairly rapidly. PE firms, VC firms, on the other hand, had a bit of an explosion in that same time period for the opportunity for people to put wealth to work in a private equity structure. So that those grew at the same time as hedge funds have coming down. And while we have not seen a reversal of that trend now, because PE funds are still very, very interesting and lots of people looking at them, we have seen the growth of hedge funds coming back in this year because correlations have broken down, volatility has gone up, the ability to generate additional alpha in a hedge fund strategy has also increased. And so we've seen a lot more new starts and a lot more people interested in it. So that the trend is showing a little bit of a change now and curving back up.
Yeah, that was a very well-informed answer. Do you think that the increase in family offices, in addition to what you suggested, is also as a result of some of these hedge fund managers who couldn't deliver the alpha anymore or didn't want to be subject to regulatory oversight, just took their cookies and went home and started their family office?
Yeah, it's also a big trend that we've seen, particularly in the last call it 3 to 5 years, is if a hedge fund isn't being successful, or they just don't want the hassle of managing investors anymore, is they convert to a family office. There's probably not a week that doesn't go by that you don't read in the press of another hedge fund manager says, well, we're converting to a family office structure.
Yeah.
So it's a fairly common outcome, I think, of the process.
Do you see that in your membership as well?
We do. One of the more challenging things that we have to do at Context is who's in which bucket.
Yeah.
Because sometimes family offices may also be in the hedge fund business. They may own a hedge fund. They may be an investor in a hedge fund. And sometimes sometimes a hedge fund may be converting to a family office. So we want to
be an allocator and looking for capital at the same time. Wow, how many times that happened? Like all the time, right?
All the time, right? And so, as you might guess, one of the things that's designed to really irritate a hedge fund who's paying a subscription fee to be on our platform is when he has a meeting with somebody who says, "Oh, and by the way, I'm looking to raise money for my fund."
Yeah.
That tends not to go very well.
Well, I think we have to live with the reality of the situation. And I don't mean to dismiss it,
No, it's just something that we're aware of and that we have to spend time on, is that the differences between the two at the margins start to be a little blurry.
So we have a couple people that have raised their hand. Just for the record, we can't turn on your audio or video. So if you don't mind just writing it in the chat box, that would be great. So how would what's the profile of the good customer for Context in terms of the subscription?
Yeah, so a good customer for Context tends to be obviously if you're any kind of alt fund, we're interested in figuring out whether we're a fit for you or not. But I would say that the funds that turn out to be most successful on our platform historically are funds that are newer, more in an emerging, either emerging manager themselves or they're in an emerging space, and are bringing something more to the table than just, hey, I'm a long short equity guy.
Yeah.
Because what we found is on the allocator side of our house is people are very interested in looking at the new and looking at what other people haven't discovered yet, in trying to find that new manager who's going to be Renaissance 10 years from now,
Yeah.
or going to be Millennium 10 years from now. So we see that interaction much more than we do, hey, I want to allocate to the $10 billion hedge fund who's doing, is a household name. So we don't have much of that on our platform. Quite frankly, we don't see much demand for that on our platform.
Yeah, well, that's fair enough. I mean, again, it is what it is, so it totally makes sense.
Yeah.
How have you handled? So one of the things that's seemingly daunting about building a platform like yours and having it usable is having the data current. To proactively have to do that at the context level, I mean, you'd have to hire a staff of people and whatever. How are you managing and compelling those hedge funds to make sure everything's current?
So we do it really in a couple of different ways. The first way is obviously there is still a manual interface when we need to, and so if we don't have updated numbers and we can get those updated numbers, somebody will grab them and try to update the numbers on the platform. But what we did is we built some technology now that allows a hedge fund to just include our email address for Context 365 as they distribute their numbers to the rest of their investors. And we will auto read that and update their numbers automatically.
Nice. Yeah.
It's one of the ways that help them and helps us keep our numbers updated, and it keeps this from becoming an overly manual process, which I think is important. If a fund isn't doing that, a fund doesn't include us, or we haven't been able to find their numbers, or they haven't updated, they can go in and update it themselves if they want to, right, as a subscriber. But if they haven't done that, we actually identify their numbers as stale.
So they need to, so the one viewing it will recognize that they need an updated, yeah.
Right. And so one of the, and this won't surprise you, but one of the patterns we've seen from allocators is if a fund's numbers are stale, they don't want to meet with them.
It's an indicator, right? Yeah, yeah.
Not necessarily true, but generally true. Like, so if they haven't bothered,
coercion works.
so if they haven't bothered to update their numbers, maybe they're not good, or maybe they don't care enough. So if they don't, then I'm not going to spend my time meeting with them. So it's a little bit of a incentive for the funds to keep themselves current.
Yeah. We have another question from the audience here. If you don't mind, we'll get to it. There are times when it's better to allocate to a stock like prior to an X date or something like that. Is there something you can comment about when it's a good time to allocate to a hedge fund?
I don't know that there is. Some of them may be strategy driven that might have some timing around them, depending on what kind of strategies that they do. If it's a dividend harvesting strategy, for example, there may be better times than others to be investing in a particular fund. What we've seen, particularly under the new 365, sort of operating system that we're under now, is that allocators really like the ability to put their money to work when they want to put it to work. So we've not seen a clustering around time. I would say the other reason is sort of idiosyncratic to the investor, is their taxes and trying to,
right.
when are they, how are they measuring their taxes? When are they having tax effects? Do they want to take tax losses in a certain way? Do they want to take gains in a certain way? And so a lot of timing that we've seen on the allocator side is driven actually by an investor's tax situation, and less about a fund's behavior.
So we talked about what type of funds are on the platform, and you mentioned more emerging strategies, alternative, and you mentioned a couple like crypto and settlements and that sort of thing. Are there others that are
Yeah,
creating
yeah,
uncorrelated returns?
yeah. So we've seen some really interesting strategies in the ESG space. Trading California carbon credits, for example, again, an asset class that's not commonly well understood. And So we've seen a fair amount of that kind of activity showing up as well. A lot of interest in those kind of, or those areas, ESG most broadly, but really, environmentally sensitive opportunities that we've seen. I think I mentioned SPACs and SPAC funds have been an area that we've seen a great deal of interest showing up on the platform. We've seen some futures and options volatility strategies, particularly this year, as opposed to for 2021 as opposed to 2020. So as people have seen volatility start to creep up across a bunch of different asset classes, we've seen a lot more interest in sort of more complicated derivative strategies that are betting on volatility outcomes, if you will, using options and futures. And so that's been an interesting thing to watch as well. Trying to think what else has been
Is
more.
shorting?
Shorting remains an area. I think that GameStop,
Probably
sort
catalyze that. Yeah, yeah, yeah,
of scared everybody a little bit around that, is whether I get squeezed.
yeah.
But and but I think it's become and will remain an area of great interest. We've seen a lot more interest in what I'll call traditional long short. We've seen some funds now that almost every long short fund that shows up typically has a long bias. Uh,
Mhm.
and we've seen more funds now, more recently, who are long short, who have a short bias, where that's where they think they're going to generate their alpha, which is, uh, not a giant change yet, but it's something that we're starting to notice on the platform, funds that are on that side. And we've seen a lot of specialized long short, meaning less macro, more sector specific, like people who are in the mining area, for example, or natural resources in other areas where they are domain experts around the fundamentals of that sector,
Yeah.
are really starting to approach it from a long short point of view.
So you mentioned, we have another question. I'll summarize it. That you've done a couple crypto meetings with your members and so forth, and just by definition, in a new thing, there's a learning gap. Have
Yep.
you been seeing an appetite for that gap to be narrowed?
We have, and it's again, historically, context hasn't been a big platform for content or education. We've been much more interested in trying to be a facilitator of people finding one another appropriately. But what we've seen, particularly in these new emerging strategies areas like crypto, like SPACs, uh, is a demand for more education. And way education, and I mean that in the broadest terms, because the people who are on our platform and the people we engage with are typically very smart. They're very sophisticated. They know what they're doing. So it sounds insulting to say, well, they're coming to us for education. So what they're really coming for is how do we narrow that gap that you just mentioned between someone who lives this space to someone like me who may want to invest in this space? How do I narrow that gap? And so we've seen a lot more demand from our customers for that kind of content. We did some with crypto. We'll be doing some stuff with SPACs coming up. And I suspect we're going to continue to evolve that as we go forward to help people really learn. You know, one of the things, some of the funds on our platform sometimes complain about this is some allocators will do a lot of tire kicking. And so if they want to they're interested in a space before they pull a trigger on an allocation, they may meet with 5, 6, 7, 8 funds.
Sounds pretty normal to me.
Right. And, you know, but they're learning while they're doing it. Right. So, you know, they're like, all right, I don't know enough about this space yet. So I'm going to meet with everyone I can find that's in this space because I want to know more before I decide if I want to make an investment in it or not.
Yeah, and I get it from the fund side saying, well, wait a minute, are you want to learn on my back and then I'll probably never see a check. And so I guess just one of the things I guess you have to live with. And I'm not dismissing their concern. I'm just saying it's sort of.
No, but I think it's the nature of the beast. And I don't think it's any different now than it was prior.
Yeah.
As a matter of fact, you know, as a matter of fact, I think with this digital platform, it should be easier for everybody because you, Arthur, don't have to hop on a plane to see somebody. You can just go on the platform and do your research and have a meeting with them. So I think there's a certain efficiency for everybody in that kind of environment.
So what's the criteria to have you allow somebody to be on the platform as a manager, aside from paying? You know, one is that, you know, we don't, and this gets to be, you know, to liability and legal arguments and all of those things. So I'm just gonna say it as it is. We are not in a position to vet all of these funds and say they're good to go, right? So, you know, typically what we're looking for is, you know, somebody who's, you know, knows what they're doing, you know, in broadest terms, is organized as a fund, is registered in the, you know, with the appropriate regulators and in the appropriate way. And once we have all that documentation, it's, you know, quite frankly, buyer beware. Buyer beware, yeah, of course, yeah. Well, as long as you're clear about what you're doing and not doing, then it's, you know, it's up to whoever's.
Yeah, one of the interesting things we've seen is we've seen some growth on our platform of people using it for due diligence. So once they've had their initial meeting, they may coming back and doing a lot more meetings on our platform, exchanging documents, messaging one another, you know, because the in-person visit to offices just isn't happening anymore. Yeah. So if I'm interested in making an allocation to this fund, you know, I'm going to do what I can. And one of the ways they can do that is continue to have a lot of meetings. And we've started to see some of that behavior.
So since you've made this robust and since COVID, have you seen the growth for your subscriptions steadily go up, have a big pop? What do you
So,
see?
you know, it's still a little new because October was really the sort of the relaunch. And, you know, I think the industry in general is still very used to, and this, you know, quite frankly, represents a challenge to us, but I think it's a challenge for anyone. The industry is so used to event driven. Yeah. So these 2 days, we're all going to get together either virtually or in person to meet one another. And, you know, as this model starts to evolve itself, it's evolving in a way where it's not event driven. I don't have to have all my meetings on Friday. I can have them, I get one on Monday, one on Thursday, 2 on Friday. Yeah. So as that behavior modification has changed, we're starting to see a very steady ramp up, which has been nice, you know, quite frankly.
Well, if it's helpful to anybody, when I've used the platform to interview a hedge fund manager, I just had a cocktail while I was doing it. So
that's the way to do
it. Can we're gonna have to wrap it up here in a few minutes, but Can we talk about how one would, one, qualify to be on your platform and what that process is? And then two, if you're an allocator, what's that look like?
Yeah, so to qualify as an allocator on our platform, it's pretty straightforward. We're typically looking for, we stay away from retail. We're not a retail platform. And so, these are people who need to pass the test of being able to invest in the alternative funds that we have on the platform, right? So whatever that test may be, in terms of an accreditation, accredited investor, or other barrier that they have to come across. And really what we're asking for is, that if you want to register as an allocator, and we have a team of people whose job, we call them investor relations people. They will interview you either digitally or on the phone or on a Zoom call. But what they're really looking for is that make sure that you meet the standard of being an accredited investor, or any other qualification you would need to be on the platform, and that you are interested in putting allocation to work. You're interested in putting money to work. You're not required to. There's no obligation to you. There's no obligation for you to do any meetings either. The idea is, though, we want to make sure from our fund side, though, that there are people on the platform that they want to interact with who are interested in interacting. You're on mute, Arthur, if you were saying something.
Sorry, the plane went by. If you're not an active investor, then it's not very valuable to the other side of the trade, right?
That's right. That's right. And while there is some value if you're not active, you can use it to do research. You can look at marketing decks, and so we have chosen not to impose any requirements on the allocator side of you must have X amount of meetings or you got to interact on the platform, because ultimately this is built for that larger ecosystem, and what an allocator who's not allocating this month may be allocating next month. Yeah. So we keep that side pretty open. But then you get a login, you get a registration, you get a login. You can do it from your laptop, your home computer. We even have a mobile app for you. You can put it on your phone.
Yeah. And the hedge fund part of it is,
part of it is very similar. Typically, if you're going to pay a subscription fee to us, it's because you're looking to raise money. Though we do have some funds on the platform who pay because they want to stay on the platform just to stay in front of allocators.
Yeah, we did have an earlier question about whether all of the funds on the platform are accepting capital. So that's a good answer for.
Yeah, that not all of them are. Most of them are, but not all of them are. And some of them, and again, this won't surprise you. This becomes one of the more challenging things to deal with is when an allocator wants to have a meeting with a fund and they decline the meeting.
Right. Yeah, what's up with that, right?
Oh, what are you talking about?
Yeah.
But that does happen because sometimes the funds themselves, they're either at a stage in their development. Sometimes their returns may have gone south. They may be in a dip in their return profile, and they don't want to be actively raising funds in that kind of environment.
Yeah.
But they remain on the platform because they stay in touch with their allocators through that platform or through our platform. But they want to maintain their presence there because when they do raise money again, they want to, if the ramp up time is short, they can just come right back up and do it again.
Totally makes sense. So no pressure, but you want to share a few insightful or at least one thought with the group before we wrap things up here?
Insightful about
anything you want.
Anything.
No pressure or a lot of pressure, depending how you look at it.
Yeah, it all depends on how you think about it.
Yeah.
I just one of the things that I think is going to be that I spend a lot of time thinking about is because I'm obsessed with it right now, is the SPAC space. Is when does the edge for SPAC sponsors start to become competed out? We haven't seen that yet. We've seen it in the aftermarket. We've seen some SPACs have great success and some have not, and they move around a lot. I'm talking about on the sponsor side.
Yeah,
Uh,
yeah,
and there's been no slowdown yet, and there's been no competition yet that's taken out the edge and the margin
yeah.
yet.
So it hasn't compressed yet. Yeah,
It hasn't compressed yet, and I suspect that we almost have to, right? Because you've seen it in almost every other market over time, that if there is extra edge in there, that people compete it out.
yeah.
Uh,
Price to perfection. You know, squeeze the margins out.
yeah.
You know, sort of make it so it's not that enriched. But
So if you're going to do one, I would say, if you're going to do one, do it now.
yeah, right. Okay. No, I think that was a really good, insightful. Thank you for that. Well, this has been super fun. I really enjoyed it, and I hope you did. And
I
the
did very much.
audience, the context is open for business, so we'll make sure that everybody's connected and share the list, of course. And really, really interesting. And like before I knew it, you know, an hour is up. So. Appreciate your insights and your contribution in doing this and allowing me to do it with you. And we have, there we go. There's
Yeah.
somebody that just posted the Context 365. Thank you, whoever did that up there. And as I always say, thank you for, oh, just one more thing. We are going to record this and put it and post it. So just if anybody can benefit from watching it, and anybody that you know in your in your communities or anything like that, that would be awesome. And as I always say, thank you for spending the only thing you can't make more of, and that's your time with us this afternoon. And until next time, thank you, Eric. And
Thank
Nicholas,
you.
thank
I
you.
really enjoyed it. It was
Take
great.
care. Bye-bye.
Bye.